Well, hello everyone, and welcome back to episode 115 of the Man and Machine, here with the PeakBot team and Mark Phillips from Harvested Financial. However, you do see a new but familiar face here as well, Matt Cashman from the OCC, our fellow options nerd. What's going on, man? How are you?
Hello, options nerd. I love that. Options nerd here. Love it.
I hope that's a compliment, you know?
Oh yeah. Yeah.
Okay.
That's a terminology we throw around in positive ways in my line of work.
Well, thanks so much for joining us this morning. We have a great show, a lot to talk about here today. So buckle up. We're going to keep things moving. I am going to get some music on. Ben, do we typically go with a specific track to get us started here?
Let's feed some ducks.
Feeding the ducks is the name of this one. Well, we have a quick review of PeakBot picks. We're going to talk about stocks in real life this morning. We're going to be discussing Microsoft, our personal experiences with the company, and we'll take a look at some charts and numbers as well, and a ton more. We have a fantastic session on the Rule of 16 here with Matt Cashman, and a lot of options knowledge to come. So hang tight. We're going to move through this thing here, and we're going to get you started the right way for a new week of trading. So, gentlemen, unless there's anything I missed from the agenda here, what do we say we just get right into it?
Let's hit it.
Amen. All right, PeakBot picks. So I'm actually looking at it right now. For those of you who are not familiar, myself, Ben, and Thomas, our partner over at PeakBot, we all make 3 picks a week. This used to be paper trading. Now we actually take the trades in our Tradier accounts, fully automated by PeakBot. We each take 3 of them. Last week, my 3 trend spread trades, we're all winners. 3 for 3 for this guy. Been a few weeks since I pulled that off. All profitable trades. I had 2 put spreads on TLT and J&J, a call spread on Zoom, and walked out with all my cash. Okay, I paid back a little bit of premium. But Ben, how did you fare last week?
Well done, Dillon. I went 2 for 3, so not as good as you. However, I'm going to turn my 1 into a win. That was XPEV. I wound up getting assigned shares on XPEV because at expiration, the price of XPEV was between my strike prices, right? So that leads to assignment if I want it. Now, if I left the trend spread bot on, those contracts would have been rolled to the next week's expiration. However, I don't like to lose. I want to turn my losers into winners as much as I can. So I took the shares, and this week I will be selling calls against those shares. And I'll continue to earn those credits until my cost basis is essentially 0, or XPEV goes back to the price that I was hoping it would be at last week, and I can walk away selling the shares for as much as I had to buy them for. So 2 for 3 for me. Not going to achieve victory this week. I'll let you have it this time. But how did Thomas do?
I needed the victory. Thomas also went 2 for 3. Net loss. He took a brutal. He took a beating on a call credit spread on Pepsi, which is like one of his cornerstone plays.
Pepsi's like Walmart is to you.
Yeah. And for a while, I mean, he was riding the wave down on Pepsi for quite a while there. Came back to bite him this past week. Without looking at it, I think he was trying to stay like under 149. I don't think he did. Anyway, so 2 for 3 from Ben and Thomas, 3 for 3 for me. Cumulative good week, green week. We'll see how we do this week. Tune in for Friday. Awesome. Okay, and I know I'm not going to ask Mark or Matt like who they're rooting for in this competition because I know who it is. Everybody loves an underdog story. So let's move right on into stocks in real life. I think we have a good discussion today on Microsoft. I'm curious to know what their saying is, their slogan. So Ben, I'm going to put you in the top spot. I'm going to hand it off to you, gentlemen. Let's have a fun one here.
So we've got Microsoft and stocks in real life today, and we've got assistants that put these slides together first. So I was kind of surprised when this logo came back. What year, guys? What year do you think this Windows logo is from?
Ooh. This is like 94, 95. Is this Windows 95?
My guess was going to be 95.
Yeah, I think it's Windows 95.
It seems newer to me. I don't know why it's tripping me out. I almost feel like it's close to what their current logo is, if I'm being honest with you. Maybe I'm tripping. I don't know, but I don't have a guess. Do you have the answer, Ben?
It is the Windows 7 logo. I thought
Which is
it was
not that long ago.
It's not that long ago. It's not that long ago. So Windows 95. Here, hold on. I'm gonna pull this open for you.
Yeah. Do you have all the logos? I would love to see this. Oh,
Check
yes.
it out. Windows 1, Windows 3.1. You guys said 95, right? That's this guy right here.
Yeah. Okay.
And then it's very close to XP. But
yes,
it is in fact Windows 7.
Windows Vista. Ugh. Windows 12 is just a blue square right now. Did we do this? I'm upset. I'm working on it. Well,
Back to the roots. I don't actually remember the Windows 1 logo. Windows 3.1 for sure, but original Windows 1, that's new to me.
Yeah.
That is different. Do we have any favorite on the screen here? Matt, anything calling your name here? Is it the Windows 95?
I mean, that's the heart of when I started really using it.
Okay.
So that's my soft spot.
Love it. Mark?
Yeah, I was right around that same time too. 95 was like that felt like the mass market. Everyone was getting desktops. Everyone was logging onto America Online on their Windows machine.
Yep.
You've got mail.
It's funny to look at these to think of like how much cash went into the marketing department behind like a rebrand from like Windows XP to Windows Vista or Windows Vista, Windows 7. It's just like, wow, what a change. This is a good one. Okay. Let's talk about the business, Microsoft. For as much as we can talk about what's everyone's life experience. Are we digging Microsoft? Are we against Microsoft? Do you even have a choice? How do we feel?
Well, I think the world gets divided into two operating systems, and that's Microsoft's operating system, and then it's Apple's operating system when it comes to laptops. So I used to be a big Mac guy. I used to love the Mac. I used to love Apple's operating system. Used to love how it would connect to my phone. And then I don't know what happened. I just switched over to using HP computers and Windows operating systems, and I haven't looked back.
I know what happened. You graduated and you got a big boy job, and they operate on Microsoft, most of them. That's what happens, right? I mean, unless you're at Apple, I think you're on Microsoft. Am I wrong? What do you guys think, Matt, Mark?
I'm a big fan of not paying 2.5 times for the same technology.
Yeah.
So I stopped using Apple computers in like 2001 because I just can't I just can't do it. I can't spend like $3,000 for a computer that I know I can get for like $899.
But you'll pay $1,000 plus for a phone, right?
Yeah, kind of. I also run a Pixel phone. I run an Android phone for the same reason.
Special breed.
Special breed. Yeah, my daughter, who's 14 years old, thinks I am the strangest person in the history of the world.
She's not wrong.
I don't have an Apple product in my entire house.
Wow. Okay, that's a stance. You've taken a stance. Mark, what side of the fence are you on?
As a computer user, definitely Windows. That's an operating system that makes sense to me, like the way file storage works and everything. That was always my hang up with Apple products. But I think we can't talk about Microsoft without talking about Excel. Like literally their entire world could crumble around them and Excel would be a flagship product. Like forget about the operating system, forget about Teams, which is obviously horrible. But like Microsoft Excel is just one of those benchmark applications that you have to know how to use. It's everywhere. No matter what you're doing, you got to know Excel.
Yeah. Amen.
You got to love Excel. You can do so much with it. I mean, I think that's how a lot of people even get started coding, right? Like you can build really cool stuff with Excel. It's an incredible product.
Yeah.
Ben is, I don't know if he proclaims this himself, but I'll give it to him. Ben is one of the, freaking the sheets. He's really good in the spreadsheets. He loves himself some Excel. I will say, to me, Excel feels like very old compared to a Google sheet. I feel blocked up. I get stuffy when I'm in an Excel document compared to a Google Doc. I bet Ben, the former accountant CPA would say you're an Excel guy.
I think since I've been working on PeakBot the last 5 years, I've definitely transitioned over to a preference for Google Sheets.
Okay.
Just because of the connectivity. I know you could have Excel online now, which has that interconnectedness with your team. However, I prefer Google Sheets still, just because we're in the Google suite.
How about any guesses on when Excel launched? Do you guys have any guesses on that?
Ooh, I saw
90s, right?
I was gonna say late 80s, early 90s.
Yeah, I would have said 91, 92, call it. Like,
Okay.
Just notes, obviously, before that, I guess.
Mark, you have a final guess for a year?
91,
Matt?
I'll say.
Okay.
Yeah.
1985, September 30th,
Ew.
1985. If we're playing the Price is Right, I think Matt takes that one. By the way, Microsoft Word was 83. PowerPoint was 2 years after. Excel in 87. They were getting busy. Wow. Okay. All right. So you're right. It's such a good point. Without Excel, I don't know how so many things operate. Let's talk about, unless there's other real life experiences that we want to talk about with stocks in real life on Microsoft.
Well, I mean, I think since we are talking trading, we are talking options, like the number of shops that have some legacy tool that is sitting in Excel, calculating dividends, like interpolating balls, like, the janky spreadsheets that have like 37 versions. Every single trading shop has at least one of those.
Yes.
Yeah.
Yes. And they have one person who is like really good at troubleshooting them when they break, because that is the one hard part about Excel, is that you can build so many layers on it, and then eventually it always breaks, and you're just like, you call over some guy, whoever it is, who either wrote the spreadsheet or wrote the macros or whatever, and you're like, hey bro, this thing doesn't work anymore. Someone come fix this thing. And then they scurry over and fix it, and then it runs again.
Total job security for that, right? Like Bloomberg updates their ID, and so like you need the new spreadsheet, the connection.
Yeah.
So let's talk about the stock a little bit. Just on this theme of like guessing when things went public or launched. Any guesses right now on when Microsoft IPO? Without maybe having the chart.
I won't give it away yet.
When it IPO'd?
Yeah.
It's got to be
84, 85.
Yeah, it's in the 80s.
1986, March 13th, 1986. It's at least this is just Google telling me $21 a share. 1986 for Microsoft. So quite a bullish chart there.
Which after IPO, after considering all the splits that have happened over time, what'd you say, Dillon? $21?
That's what it was. Yeah. That's
so that's the equivalent of about 10 cents, 9 or 10 cents right now.
And isn't it true that Steve Ballmer made more on Microsoft stock than Bill Gates? I think Bill Gates has been divesting his pretty aggressively over time, and like Ballmer's actually like the leading shareholder or whatever profiteer of Microsoft stock.
Yep.
Damn.
I think I've heard that as well. Bill Gates, that's a different conversation to have.
There's a great, you guys want to hear a great option story about Microsoft?
Kidding me?
Yes, please.
Why we're here.
So I don't, Mark, I don't know if you, my old business partner stood in the Microsoft pit for in the late 90s, and Susquehanna was the DPM, and it was a guy named Fitz. Do you remember Fitz?
I don't know. That was a little before me.
Okay, he was a Philly guy, as most Susquehanna guys were at that point in time, and they knew that Paul Allen's collar order was coming in. And so Paul Allen had, millions and millions and millions of shares of Microsoft, and he was going to trade a collar to lock in, part of it. So he's selling upside calls, buying downside puts, and he was locking in a certain percentage of his whatever. And they knew that the order was coming in, and So there's this point. My old business partner would point to the previous high on the chart and say basically like, this is exactly where the actual order came into the pit. And Fitz picked up the phone because we did everything on phones back then. And he picked up the phone and he was like, you guys better get your stock now because this thing is going to be nasty. And then he picked up the phone and he priced the collar for it, because a lot of times the DPM would price the collar for, if it was a huge order, that you would get kind of like, the crowd would price it, but it would really be the DPM who was pricing it, because the DPM was doing at least 30% of the order. Their job was basically to provide liquidity, but then they get 30% of all of the flow that comes into the pit. And so it was like 100,000 collars or something. It was so massive. And if you're trading the other side of a collar, you're buying the upside call and selling the downside put, and then you have to sell stock against it. And so all of the guys would run to sell their stock at the same time, the stock, and you can literally like point to the spot on the chart, and it's the previous high. It's like, this is the part where Paul Allen came in and basically called the top using options. He didn't mean to do it, but he did it. And I remember that day he came over to me and was like, dude, you're not going to believe what just happened. Everyone got so run over on their stock. And, but those kinds of things used to happen all the time in massive trades like that in an illiquid environment. It was, it was a Wild West kind of scenario.
You're giving me
not just deltas, 100 deltas. Like a collar, you're literally hedging that 1-to-1. Yeah. So 100,000 collars is 10 million shares of stock.
Yeah, exactly. You can imagine what that does to a stock when everyone's in there trying to sell stock at the same time, right? I mean, it's aggressive. So.
Do you remember the date? Can we go look at it?
It had to have been, I would guess it was early 2000s.
Okay. Well, yeah, I was actually, Ben, when you had the chart up earlier, there was a little blip for them. It looked like maybe from like 98 to like 01, and then returned to like their norm. And then
might not be able to see. I split adjusted. I don't know what the price would be, but I remember it being like $138 a share or something at the time. 137, wow. 138.
You were stressing me. What a great story. I got stressed listening to it. Like how
you should try being on the other side of the collar trade.
I'm having to like wait for somebody to answer a phone. Like,
oh yeah, man.
My God.
Those were the days.
Oh, all right. So I mean, what are we seeing here? Obviously, Ben, what time frame are we looking at here? I gotta make my screen bigger.
This is early 2000s right here.
Okay.
But we could go back to what we've got going on this year. A lot of back and forth, it looks like, with Microsoft. If we zoom out a little bit, look at 2023, went on a nice tear there, basically doubled in value. Over the course of, what is that, January to July? A year and a half, January 23 to July 24. That doesn't compare to some of the rippers we saw over the past couple of weeks, where it zoomed like 8x'd itself in the span of a year or 6 months even. That was during COVID. I mean, we could look at Microsoft during COVID as well. And yeah, there was a good 4-ish X multiple going on here. Over the course of that time. I don't know. I know I have. I don't know how I've done on Microsoft trading it on Tradier. I guess I haven't traded it on Tradier.
Not on that account.
Not on this account, at least.
For me, the only way I would be trading it would be on trend spread for the cash, knowing I'm going to be rolling the contracts, and they're still pretty wide spreads, at least where we're selling them. So we'll take a closer look. I'm going to pull it up and see what it was doing on the watch list. Obviously, the data won't be fresh until the market opens, but gentlemen, like, for what we can talk on, what are our thoughts on Microsoft and trading it in the world of options, etc.?
This is a name that I see often with clients. Like, clients want to overwrite this because it's a big holding. And so like they want to do some covered call type stuff on this, or even like a hedged equity works with this. It's very similar to the S&P, right? Like, just in terms of implied vol levels, like this isn't a zoom. This is a ultra blue chip name. I mean, vols over the last year and a half have ranged between at the 30-day level or somewhere between like 16 and 30. So like we're not seeing crazy like risk premium in here, though there is pretty consistent positive VRP, slightly more than like S&P. The last 3 months that's been a little different, but like this is a behemoth of a stock. It's not an index, of course, it's still an individual name, but you know, with the size that it's grown to, I mean, you're pretty vanilla with this. But that means there's great liquidity and great room for hedging strategies.
Absolutely.
Yep.
It's
Matt,
about as close to an index as you can get while still only having one name associated with it, right? I mean, like it's basically its own index in some ways.
Yeah, like especially with all their diversified business lines and everything, like, you know, and what are they, 5% of the S&P now or something like that?
Yep.
Or
Is it that high? Beta
Market cap is almost 3 trillion.
Yeah, insane. Obviously, some strong analyst ratings here, although bearish as of late, as we saw. I'm looking it up on the trend spread watch list to see if we're selling the 30 delta, where we're going to fall. You can see the volatility here on the upswing.
6% of the S&P.
6%.
Only bested by Apple, who's 7. Yeah.
Damn.
A lot.
So right now, Microsoft is, at least this is as a Friday, bearish. Obviously, moderate risk.
Want to pull up your screen, Dillon? See the watch list?
Yeah, let's do it. Again, I wasn't gonna, just because it's Friday's data. We'll take a closer look when the market launches in our watch list updates. But let me get this on here. So this is what we were looking at. So Microsoft here closed right under 378. This is expected value, which is very good here. Probability of profit, which on this list we typically see anywhere from 70 to maybe a little north of 80%. So kind of falling right in the middle there. This is, what is this again? This is our ROI. So good ROI there. And then the strikes, I think it was 10 wide. I'm so sorry, guys. Wow, this is really just flopping here, guys, isn't it? It was give me 1 second. Come on. We knew I was going to all right. Here we go. $153 in premium paid for a contract expiring this Friday. $10 spread. So max loss is really $847, and we would be trying to 387.5 is the sold call there. So looking back, Ben, you got the chart up still?
I do.
Again, this will update here, but
387.5 was the strike.
Yeah. What do we do in pre-market? Obviously down a bit.
So we are bearish on it.
Yeah, bearish.
Okay. I mean, that's a tough one, right? This is a tough call to make, and especially with the $10 wide spread. I mean, we look at Friday's movement. Obviously, the market took a dump on Friday.
Sure did.
But you know, I don't like seeing that. I don't like seeing the strike price so close to where the stock price just was. I do like the trend personally. You know, downward trending since January. So if I was bearish on this and I was playing it, that would be what I would lean on. We've got the technicals here, of course, showing us a strong sell. But again, I'd like that strike price to be up a little bit higher. I'd actually like it to be around like 396, but you're not going to collect as much premium if you move it that high. We'll see where things open up today, and we'll see pre-market we're at 373.80, so about $5 below close on Friday, just about. I personally won't be trading this, but I know a lot of people do. Actually, I shouldn't say that. I am trading Microsoft via my Terry Tips automation in my retirement account.
Okay.
So Terry's Tips, really awesome newsletter, and provides trade alerts. We have automated those trade alerts for anybody that is interested in Terry's Tips. You can go to terrystips.peakbot.com. We'll have John from Terry's Tips on as a special guest to this show in the next couple of weeks, maybe the next week. We'll see. But he loves to sell calendar spreads, and he will just sell calendar spread after calendar spread after calendar spread. And it works out. He's got a great track record. So much that I've given it a portion of my retirement account over to being traded via Terry's Tips Alerts, where he will be trading Microsoft.
Can I ask a question? Can I ask you a quick question? When you say selling calendar spreads, is he actually so he's selling time? So he's buying the near-term option and selling the longer-term option?
Yes. Yep.
Okay. Cool.
And so he's doing that, and he's also he's also selling both sides as well.
Selling both sides, meaning like selling a call calendar and selling a put calendar?
Yep.
Okay.
And then he'll also be buying a leap at some points and then selling against that leap. So he's doing it all.
Oh, I love it. Right on.
I like to call those strangle swaps.
Yeah, buddy. Absolutely.
Good old strangle swap.
Feels a little more sophisticated.
Hey,
anyone can do a double calendar, but a swap, that's big boy stuff.
It does feel a bit more difficult. Yeah, I have to say, it makes it more challenging. So Microsoft, just to wrap, on the year to date, down almost 11%. Over the last 5 years, up almost 150%. So maybe bearish as of late, but certainly, as we know, one of the big dogs. And I'm sure there are greener pastures ahead. So unless there's any other thoughts or questions or comments on Microsoft, I say we get into learning a little something here.
Yes, let's do it. And as promised, and this is why Mr. Cashman is here, to talk about the rule of 16. So Matt, if you want to get those slides up, we'll get them on the screen, and then we will kick it over to you to nerd out with us on the rule of 16.
There you go. Let's nerd. Let's get nerdy.
Let's get nerdy.
All right. So really quickly, the rule of 16 is something that traders use, and option traders specifically. Mark, I'm sure, has used this a lot. It's something that's kind of ingrained in the brain of an options trader, because in some ways it's a shortcut. It's like a back of the envelope calculation that people use. But what I like to do is to try to teach it from a slightly more theoretical perspective. So to give people a little bit of a glimpse into like some of the math, not all of the math, but some of the math behind what's going on here. So let's talk about it very quickly as to like what it is. So it's a way that you can convert annual implied vol numbers to smaller chunks of theoretical, like forecasted movement. So what I really like about this is that it takes, if you're looking at a vol, right? If you're looking at an implied vols are intrinsically annualized numbers. And so a lot of times people will look at like a 20 vol or a 25 vol or a 50 vol and say, well, what does that really mean? Like, what does that mean as far as the expectation that the market is thinking about? And theoretically, how should I expect the market to move around based on the fact that the market thinks it's a 50 vol? This is a great way to do it. What it does is it takes that annual implied vol and it converts it to smaller chunks of theoretical movement. So you can use it for risk calculations. You can use it just as a way to look at the marketplace more broadly. You can even use this on the VIX, right? When you look at the VIX and say the VIX is trading 25, what does that mean? Don't forget that the VIX is just a measure of the 30-day implied vol of the S&P. And so whenever I look at the VIX and I see a 20 VIX, I instantly do this calculation in my head to think about, that's telling me that the marketplace is saying the S&P is theoretically going to move 1.25% every day for the next however many days, for the next 30 days. And then you can adjust it as it moves around. But let's talk about how you can think about it in terms of the actual math behind it. So what we're doing is we're taking an annualized vol and we're breaking it down into what we think of as a daily standard deviation. What does it mean for instance, a 20 vol as to how much that stock might be moving on a daily basis? And so the way that you do that is to get your daily standard deviation, you basically just take the implied volatility of the option that you're looking at, and you multiply it by the stock price. And then you divide by the square root of time. In this case, the square root of trading days. Now, I know that sounds a little bit complicated, but what I like to do is break it down into the numerator of that equation and the denominator of that equation to get people to think about, like, what does this actually mean? And so when we talk about that, we're talking about the implied vol times the stock price as the actual numerator and the square root of trading days as the denominator. For simplicity, the square root of the trading days rounded to 16 because we talk about the actual trading days being 252. Square root of 252 is 15.87. We round it to 16. That's the reason why everyone uses 16 in this. Let's talk about the actual numerator and the denominator separately. So the numerator, I call this the big block of variance. This is how I think about this. Some people do it a little bit differently. Some people just take the vol and divide it by 16, and they say that's how you can see what percent you would expect the stock to move on a daily basis. I like to think about it as this is an annualized number. So let's talk about it as an annual block, a big block of variance, and then let's slice it into smaller pieces. Because what you can do then is you can slice it into not just daily pieces, weekly pieces or monthly pieces, depending on what you use for the denominator. So if you think about the numerator as the big block of variance, what you're doing is you're creating annual variance. How much do I expect this stock to move over the course of an entire year? And that is implied vol times stock price. That's just the top of your ratio. And so in that situation, you look at it and you think, okay, well, if I expect this thing to move $20 over the course of the entire year, what does that mean for every single day that I'm looking at it if I'm using this implied vol? And that's where you get into slicing it into smaller pieces. So if you look at it from a total big block of variance, you can say that in this case, you're slicing it into a daily standard dev by using 252. How many trading days are there in a year? And so in this case, you're using the square root of trading days as the denominator because the fact that you need to actually take that big block of variance and slice it into a piece that you can make sense of for a day. So this breaks it down into like how we actually do it. But let's look at something that might actually be something you might see in an everyday situation. So remember, daily standard deviation is implied vol times stock price divided by trading days. In this case, let's say you had a 20 vol on some option and the stock was trading $100. So what you would do is you would take 0.20, which is the actual implied vol converted to a decimal, 0.20, multiply it by 100, which is the stock price at that point, and divide by 252. Divide by the square root of 252. So 20 divided by 16, you get $1.25. What does that mean? That means the daily standard deviation for this stock that is trading on a 20 vol right now is $1.25 per day. Now, why do I even care about the daily standard deviation? And my point to people when they ask me that is you care about the daily standard deviation because the option prices care about the daily standard deviation. And for this 20 vol to stay where it is, you need the actual marketplace to continue to deliver a 20 vol. Well, what is a 20 vol as far as a delivered perspective? It's $1.25 of movement per day. And if you can't, as an option buyer, actually hedge out $1.25 worth of movement, you're not going to be theoretically making money on the carry of that option. The theta of that option is going to overwhelm your ability to actually hedge it and make money. And so when I talk about this, I always talk about the fact that you don't necessarily care theoretically whether or not the stock moves $1.25. You care about your options, and your options care about whether or not this stock is moving enough to pay for it. So in this case, we're talking about $1.25 being the daily standard dev from that 20 vol. This means you're looking for $1.25 of movement. Now, movement doesn't necessarily denote direction here, right? We're just talking about gross movement. We're talking about how much something might move that is a hedgeable move. And you can think about it in that way when you're thinking about standard deviations. So the other thing that you can do here is that you can change that 252 to be something different than that. We're using that as trading days because we want to actually translate the annual variance into a daily number. But you could do the square root of 12 because you want to think about how much this should move per month, or you could do the square root of 52 because you want to figure out how much it should move per week, theoretically. All you're really doing, the thing that I want to drive home here is that you're taking that big block of variance and then you're slicing it into smaller pieces that you can think about that help you to think about, like, how much should I expect this thing to move on any given day over the next 30 days? And so that's how people use this generally.
Quick question. I don't want to interrupt the flow here, but I just want to, I know a lot of, and I did put the banner up on screen here. If anybody has questions, text them in after we're done with these slides. We'll have some time for Q&A. But a question, Matt, because I know that a lot of people watching are big fans of 0DTE.
Yeah.
Right? How can this rule apply for like same day movement? I mean, we can see what the overall daily standard deviation is for the day, but let's say, you know, I'm getting into a position at 12 o'clock expiring today.
Yeah.
What do we do in that scenario?
In that case, what you're really doing, as you get closer and closer to expiration, you can rely less on this as a calculation and more, I think, on just the straddle price of the option, right? The straddle price that is implied by the option that you're trading. And you can just do that by looking at the actual price of the straddle of the at the money options together at that point in time. What that is telling you is how much the actual implied vol is forecasting for the rest of that trading day, right? For how much movement the market expects for that to occur over the next 8 hours or 6 hours or whatever it is. And so the closer you get to those 0DTE options, I think the less you can think about this as a forecast of 30 days of movement or 60 days or 90 days of movement or whatever it is. And more you can start to like focus on what the straddle price is. But that's really just the same math, just happening with one price iteration as far as the actual settlement price that's happening at the end of the day. It's still the same math. It's just you only have one day for that to work. And we've talked endlessly about how 0DTE options are different than, an option that has 30 days in it because of its time horizon. That is reflected in the actual change that you can make between, like, I can think about this as a 30-day option. I can think about this as a one-day option. On the one-day option, the straddle price is really what you're looking at. And in this case, you can think about more of like standard deviations and how much I should expect this to move on any given day over the next 30 days, right? Or the next 20 days or whatever the duration of the option is.
Yep. Awesome. Great explanation. So for everybody thinking about 0DTE, maybe just look at that straddle price. And that's your best gauge there.
That's always a good place to look when you're doing those things also,
Yeah, and I definitely agree with that point that the closer in time you are, the more important that straddle becomes the benchmark you want to look at, and going further out to the abstraction of like an implied volatility number. But this is super useful for kind of treading back and forth between both worlds and understanding dollar movements versus annualized percentage or weekly percentage, whatever it might be.
Super useful tool for anybody trading our trend spread bot as well, because those are weekly trades right there. So if you want to have a good solid estimate as to how much that particular underlying is going to move, or the price of the option is going to move in the course of a week, then here you go.
This is a really great. Just a quick aside. When I was actively trading options on a desk, this number, this daily standard deviation number, was tattooed in my brain for every single asset class that I was trading, right? When I was in London and trading Boone Bobble shots, I knew what the actual standard deviation of the Boone was. I knew what the standard deviation of the Bobble was, and I knew what the standard deviation of the shots was. And if the actual, measured change from yesterday's close was not that number or greater, I knew most of the time that the options were going to decay more than they were slated to decay, because people see that as this thing is expected to move, 100 ticks and it only moves 70, right? As an options trader, you think about that as like, okay, well, it's not really delivering the same vol that it's priced at. And so that's something that I think people can use just all the time when they're looking at just movement from yesterday's close. You need to be able to think about it using a framework that makes sense, and just being like, well, it's a 20 vol, like, I don't know what that means, isn't really acceptable anymore in this environment, right? You need to understand how much, if something's trading a 50 vol or a 70 vol, what does that mean for how much you can think about it moving every day for the next 30 days? And I think there's a big difference between, something trading a 20 vol and something trading a 30 vol. And you need to be able to think about that and be able to, like, if you want to make quick decisions, to be able to make those decisions quickly by using something like this as a way to think about it.
So as a way to like help contextualize what's going on, particularly in like vol regime shifts, right? Like now, for example, is, so we're down 80 basis points, 85 basis points this morning. VIX is at 22. How relevant is that, right? Like, is an 80 bip move what I'm expecting out of a VIX of 22?
Yeah.
Do the arithmetic, and it's actually probably slightly less than you'd expect out of a VIX of 22, right?
Exactly.
VIX of 22 is telling us that we should be seeing 130 basis point moves every day. Mm-hmm. And if we're only doing 80, that's an inclination that, hey, maybe realized is slowly kind of falling compared to what the market's implying. And the same thing happens when it jumps, right? You see that big down day or even big up day, all goes both ways, and VIX is in the mid-teens. We're only expecting 80 or 90 basis points. So I use it on an everyday basis. Just what is this VIX reading? What's the S&P delivering?
Yeah, absolutely.
Incredibly helpful. You guys kind of answered this, but Matt, when you were trading, the first question I'm thinking of when you're presenting on this is like, how early does this come into play for you? When you're looking at an option, when you're looking at a stock, and you kind of said it, it's just tattooed. It's almost just there. It's your starting basis of now we can go and dive deeper. Is that the case?
Yeah, I think it's like interchangeable, and Mark might have a different view of this, but for me, the idea of implied volatility and straddle price, right, are kind of primary to how I viewed the entire vol universe. But then implied vol and movement are two kind of sides of the same coin that are interchangeable in your mind. And when I was like really actively trading, there was no difference between thinking about an implied vol and thinking about a standard deviation. It was the same thing to me. Mm-hmm. Like the calculation happens almost immediately. And so when you get to that point, you start to think about it, and you can actually talk about it with other people who think about it that way in an interchangeable way, right? It just becomes like, when you're talking about vol, we can talk about vol if you want, or we can talk about SDs, but we're basically talking about the same thing.
Yep.
So.
Well, it helps you like, so the VIX is up 5% today. Like, if that sounds like a lot, but VIX going from 21 to 22 is only marginally adjusting the daily expectations of moves. Exactly. So like, I think why people say you can't quote the VIX in percentages and stuff like that. And I think that even points to some of the difficulty of being short vol, right? Like, your short vol from 21 to 22, you lose 5% of your money or 4.8% of your money. Whereas like that daily move isn't really changing that much in that context. So like, it's an important bridge between kind of dollars and cents of reality and like theoretical distributions.
Yeah, agreed. And that's part of the reason why I put this thing together. I'm going to be doing this presentation a lot over the next like month or so. It's something that I think is a good, kind of where the rubber meets the road kind of vibe, as far as especially in a volatile environment like this, where vols can move around a lot, and something like I said, trading on a 50 vol or trading on a 70 vol, that gives you completely different expectations as far as, especially when you extrapolate it out to 30 days of movement. That's a massive difference in how much movement you're actually looking for. It's important to be able to look at the vol and be able to translate that into like, how much does this thing need to move in order to justify the prices that these options are trading over the next however many days. And that can, it can happen like that. So it's important to think about that.
Awesome. Love this session. Love the nerdiness of the session. So I appreciate that.
I learned a lot.
Appreciate that as always, Matt. I think we've got time for a couple questions. We did have some texted in. Matt, take as long as you want with the answers to these. We will have to wrap in a couple minutes though, but I won't cut you off, I promise.
Okay.
So the first one that came in that I wanted to bring up is, what's the difference between the daily standard deviation and the expected move that's displayed in some brokers?
That's a good question. I'm going to say I would lean toward the fact that it's probably pretty close to the same thing, but I think you need to be able to suss that out by looking at what their actual calculation is, because some people do it a little bit differently than others do. But generally speaking, I'm guessing it's going to be the same thing. If you're using, remember that top number is the big block of variance. That's an annual number. And then you're slicing it by using the square root of 252. That's going to give you a daily standard deviation. That's probably what people are talking about when they're talking about expected move, but I'm not completely sure from platform to platform how the actual calc is being done. I don't know, Mark, what do you think about that from a...
Yeah, no, I was totally going to agree and say it definitely depends on the calculation. And another catch might be earnings, right? That if there's an earnings date in there, that's going to throw off everything, because this calculation assumes every day looks the same over that period. Whereas we know that with earnings releases or any news, FDA, whatever it might be, that hunk of variance is going to be concentrated in one day. So a 50 vol might mean 90 vol on one day and 30 vol for 10 days. So like expected move is often thrown around with earnings. So that's another catch I would be careful of if you're looking at someone else's calculations.
Yeah, agreed. But the bottom line, the answer to that question is like, go in and figure out what math they're using. Don't just take it at face value, like think about what that actually means and then ask some questions as to like, what kind of math are you guys using to do this? Because some people might do it differently.
Makes sense. Awesome. Next question. Is there a rule for the accuracy of the rule of 16, i.e. is it true, or is it the further that you look out, is it considered less accurate? Curious how you answer that question. So is there, I'll let you go for it if you understand the question.
I understand the question. I think when you think about the way that options are priced, as far as like the normal distribution curve, the farther you go out, the more price settlement iterations you're building into the expectation of the model. And so the farther you go out, the more theoretically accurate this is going to be, just because of the fact that you're adding a larger sample size of price iterations into that actual, the data sample. I hesitate to use words like it's more accurate or less accurate. It's really just an assumption that you're making based on how many days you're building into your actual calculation. And so it's hard to say it's like more accurate or less accurate. The more days you build in, the more price iterations you have, and the more likely it is to fall within that normal price distribution curve. And that's kind of like the baseline assumption of the modeling of the options in general, right? I don't know, Mark, you have any opinions on that?
Yeah, totally agreed. I think it's definitely a time thing. And like, I always like to say, like, when you're looking at 1 day to expiration or 0 days to expiration, like, it's like sports. As long as there's time on the clock, anything that can happen. So like, you can't necessarily say, hey, we're only implying a, $2 move today. Like, if the bell hasn't rung, like, things can always do something. So and the understand the horizon there, I think is just as important.
And the close, like I said before, when we were talking about this, when someone asked about 0 DTE options and then the rule of 16, the closer you get, just like Mark said, the closer you get to the expiration, the more you should be thinking about it as just, I think, a price, right? Not necessarily, because it's hard. I think a lot of people look at those 0 DTE vols, the vols of the implied vols of a 0 DTE option, and they want to be able to suss out some amount of, like information from it that's just not necessarily there because of what Mark just said. This is a 1 day situation, right? This is a single price iteration at the end of the day that's going to determine what this option is worth or not worth. And so when you're looking at it in that way, I think you need to start to focus more on like how much premium, how much price is involved in this thing, how much movement is forecasted for the next like 8 days or 8 hours, and does that jive with what I think is going to happen? Does that like align with how I think this market is moving? You can start to use a little bit more of the like theoretical math that we're talking about here, the more days you build into it, into the duration of the option, because of that, you know, of the bell curve that we talk about all the time.
Yep. Awesome. All right. Well, I know that we are coming up to the opening bell here. I do have a couple more questions. Maybe we could get those answered offline. You kind of just answered this one. I'll let you briefly touch on this, and then let's wrap here, guys, because I know that we all got to get going with our days. But the last one that I'll ask here is, why wouldn't you just use the straddle price for like a 360 DTE contract as well? Like why not? Because you were talking about that in the context of, you know, 0 DT, just use the straddle price. Why not just use the straddle price for these longer term expirations as well?
You, in essence, you are using the straddle price, right? I mean, like the straddle price and the implied vol are kind of like interchangeable. But the reason why you don't necessarily use the straddle price when you're thinking about it in that way is the same way that you don't use the annualized variation number for or variance number for a year long of variance that you're expecting from an option. It doesn't make a lot of sense to you from a like day-to-day basis. You can look at something and say the straddle's $38 and, you know, it has a year and a half in it, and that doesn't make a lot of sense to like, okay, so what does that mean from a daily expectation, right? But ostensibly what you're doing is the exact same thing from a calculation basis. You're just taking that big chunk and slicing it into daily amounts of movement that you're expecting. So it's kind of like it's a chicken or the egg kind of vibe, right? It's like one or the other. It's the same. It's all the same math. I'm just trying to present an idea so that people can use it and break it down in a way that they can actually look at from a daily perspective and make sense of.
Love it.
Excellent. Well, this was a fantastic show. Not just saying that. I learned a lot here. Incredibly helpful. Great questions. Great session. Always love wrapping on options with this group of 4 here. So thanks so much for joining us. We had over 1,100 live viewers here this morning. So of course, we will be live again on Friday for the Automation Station at 11:55 a.m. Eastern for myself, Ben, Thomas, PeakBot Picks. Oh my God, I just sunk my chair. I'm lower now. I'm back. So that hasn't happened live on air yet. Anyway, thank you so much for joining us. For a full list of PeakBot's products and partnerships, check us out, linktree.com/usepeakbot. Matt, thank you so much for joining us again. We will have you back on whether you like it or not. And as always, thanks so much, and we'll see you at the peak. Take care.
Take care.
You guys.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.